Joining me this morning is a very special guest, Feroze Azeez, Deputy CEO, Anand Rathi, takes time out this morning. Feroze, help us understand what are the 4 or 5 critical factors which are resulting in the market crashing yesterday?
Good morning, Karthik. I think, of course, like you already alluded to the several reasons, of course, the virus is one of the primary concerns, which gave a little shock. But what is very important to notice is this 400, 500 point fall on Nifty has come after a short squeeze on the last expiry. The last expiry, which was Thursday, which was just about one trading session before the Monday session, you saw that there was a huge short covering. The short covering was such that on Wednesday, the long short ratio, FIIs were long only 13%. That became almost 18-19% in a single day. So shorts got covered because the market over in the 2-3 hours of expiry, the last 2-3 hours of expiry, kept breaking those call levels where there were open interest. That's one reason. So anytime a fall comes after a large rise, I would say that's the reversal of a position which was a temporary expiry move. That's point one. Point two, if you look at what happened yesterday, there are several participants in the market, in the cash market. We break it down very minutely. We break it down into PMSs, AIFs, mutual funds, insurance companies, bank treasuries, retail, corporates, what kind of cash market transaction they did yesterday. You'd be intrigued to know. Yesterday, the DIIs bought, the FIIs sold nominally, but the retail and others categories, HUFs, trusts, and corporates, they have sold. And those are the most price elastic group. And when they start selling, they don't look at price, they panic. So it was a sentiment dampener yesterday, and that's why I would try to correlate it with your virus hypothesis, that was the key reason why the retail guys panicked a little, but the DIIs and the FIIs were doing normal course.
All right. Well, I understand the DII, FII and the selling pressure there, but Feroze, the health ministry has come out and said that this virus strain is not a new one. There is nothing really to panic. I remember when you and I used to speak back in 2020, 2021, you said that markets don't like anything new. Markets don't like a sudden change in status quo. And do you think the HMPV is actually one of those moments where there is a temporary blip? There is a sudden scare, but that scare is not really going to be a long-lasting one, but just a temporary one?
Karthik, I think it's going to be a temporary one. And I'll give you why I would make that comment, and I have to substantiate such large claims, right? And you see a Nifty kind of an index falling 1.62% in a single day. If I make a claim that it's going to be temporary, I'll have to substantiate that. Let me substantiate that with you alluding to the COVID periods and before and after that. There's one thing which has dramatically changed, and I don't think market participants, media, experts are taking note of the most important thing, in my opinion, I may be wrong. On the 22nd March of 2020, there was a circular which SEBI gave one day before the lockdown. That circular limited India's shorting capability of a person. If I have 3 lakhs in my bank account and I want to buy options worth 1 rupee, I can't buy, I'm not permitted. So there is a shorting limit which has been there for the last almost 4.5 years now. So because of any such shocker, global other economies don't have any shorting limits. So I would say we are a more investor-friendly and lesser speculative-friendly market than we used to be pre-COVID levels. So that's why I'm not too perturbed which falls, because anybody who actually has to bring down the market cannot use his cash margin to short the market, because 500 crores of notional limit is there, and in options you can utilize that limit with just 2 lakhs of premium for this expiry. So I'm not too worried about shockers like in the past. I think SEBI has done a big favor to investors in a market like this by keeping that circular alive for 4 years, and it's wanting to strengthen it from 1st April. I don't think this has been a story which the media has caught.
Fantastic. No, wonderful hearing this from you. And of course, this is something that we would, of course, further harp upon in all our coverage. Feroze, thank you so much. But before I let you go, I want to understand from you, if it is not going to be the virus scare, are there other scares in the market right now which are likely to continue spooking investor sentiment? And this includes, of course, Donald Trump being one, and the tariffs, and of course, the FPI investors sitting on the sidelines again, waiting for Donald Trump to make his moves when he assumes office.
Yes. So, Karthik, I'll break this down into two. I think every investor if you're an investor, if you're a trader, there are three different kinds of hats you have to wear. Some people wear both the hats. Now, if I just take a moment for an investor hat to answer your question, of course, there'll be several things which will spook the market, and the markets will correct. What I get perturbed is falls beyond 20%. From the 52-week high. 52-week high was 26th of September, which was 26,213, if I'm not wrong. We are already 8-10% down or a little over that. I am not too worried that this kind of correction can expand beyond 20%. That's one thing. And that's the only thing you have to be worried about, because market falls 10% every 10 months for the last 24 years. That's the aggregate peak to trough you have seen. So I don't get perturbed by the second nature of the market. Now coming to the trader has to see completely different barometers. If I look at those barometers, also I'm reasonably confident, because the FI long short data, one of the barometers which has proved to be the best lead indicator in my analytics and actual testing as well, that actually as of yesterday, FIIs are long only 17% in the futures, index futures market. Market steep corrections don't happen when FIIs don't have leveraged long position.